This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on trading tight bull channels. I want to begin by describing what I mean by a tight bull channel. When a channel is tight, it's a breakout on a higher time frame chart, and when the market's in a bull breakout, it's better to only look to buy. Sometimes when the market's in a bull trend, it can have a bear channel, and the bear channel can be very tight. It's usually a bull flag. However, if it grows to 10 or 20 bars and then has a big bear breakout, that's a bear breakout below the bull flag, and it can lead to a bear trend and a measured move down. There are 2 types of channels. They can be tight or broad. Sometimes you cannot tell the difference between the two. And when you cannot tell whether it's tight or broad, trade it like it's tight and only trade in the direction of the trend. When a channel looks like this, it's a breakout on a higher time frame chart. Only look to buy. The pullbacks only last a bar, a couple bars here. The pullbacks are small. Here, the pullbacks can be big, and some of the reversals can be strong enough to make you think that the market's always in short. In fact, it can be always in short, but it's still a bull channel if it's forming higher lows and higher highs. You can see the pullback here lasted 8 or 9 bars. Pullback here, very big bear bars, couple legs down. Much stronger selling in a broad bull channel than in a tight bull channel. Again, when it's in a tight bull channel, traders should be buying for any reason. They should buy below bars, betting reversals will fail. They can buy above bars, betting on a resumption of the bull trend here and here. And they can buy strong bear breakouts, betting that the reversals will fail. So they can buy the close of a big bear bar. When a channel is broad, you can buy for swings and for scalps, but sellers can make money scalping, selling above bars, selling above a high, scaling in higher, and then getting out break even on their first entry and a profit on their second entry. The bears are reasonably strong, very big bear bars, a series of bear bars during the pullback, and therefore enough selling pressure so traders can make money selling, sometimes even with stop orders, but certainly with limit orders. Bulls will buy reversals up, higher low, major trend reversal, strong breakout, bull flag, every pullback. They're buying pullbacks. Here, they're buying for any reason, including breakouts to new highs. They could buy above a prior high. Here, when you're in a broader channel, when the market goes to new high, bulls sell to take partial or full profits, and they prefer to buy pullbacks. And the bears will start selling at prior highs and on reversals down. For example, a stop below here, a micro double top, a wedge, 1, 2, 3, failed breakout above this high. And they'll also place limit orders to sell at a prior high and sell more higher, especially on a reversal down. The reason why I draw a distinction between a tight channel and a broad channel is because I trade them differently. When a channel is tight, it's very difficult to make money selling, and most of the pullbacks do not fall far enough to allow a bear to make money, especially with stop orders. And therefore, since it's difficult for the bears to make money and the market's going up, it's better to only look to buy. Whenever you look at a chart and you can see that it's relatively easy for the bears to make money in a bull trend, then assume the channel is broad, and you could probably trade in both directions. However, if you look at a chart and you look at it and say, well, how can the bears possibly make money? The reversals are small, they only last a couple bars. Even selling above bars, it's not pulling back enough to make money. If you look at a chart and come to that conclusion, then the channel is tight and you should only look to buy. When I think a channel might be tight, I'm looking for characteristics that increase the probability that in fact it is tight and I should only look to buy. Do the pullbacks only last 1 or 2 or 3 bars? Here a 1 bar pullback, here a 2 bar pullback, here 2 legs down, but only 1 bar breakout below the low of the prior higher low. Is the pullback small relative to an average scalp size? And meaning an average scalp size is 1 point, and are the pullbacks all less than 2 or 3 points? In other words, it's very difficult to make money scalping if you're shorting. Also, I look at the size of the pullbacks. Are they small relative to the height of an average bar? If this is an average bar, are the pullbacks less than 2 to 3 times the size of that bar? And if that's the case, again, very difficult to make money selling. When you see a sell setup that would allow traders to enter with a stop, and the bears have a decent sell signal bar, here it's a second entry short, first and second, yet the bears are still losing, selling with a good sell signal bar and a second entry short, then you should not be selling. You certainly should not be selling with stop entries. The channel is probably tight, it's probably a small pullback bull trend, and you should only be looking to buy. Most of the pullbacks only pull back a third to a half of the prior bull leg. Here, the pullback is only about a quarter of the height of the prior bull leg. The pullbacks are small. And you see a lot of gaps. Here's a bull trend resumption, so its low creates a gap with the breakout point before it, so we have a gap. This low barely tested the high of this buy signal bar. We have a breakout above here and barely overlapping. If a bear sells at a prior high and scales in higher, is it very difficult for him to make money, or is he getting trapped? When you see gaps, it's very difficult for bears to make money with limit orders. Selling at a prior high and scaling in higher, you need the money to come back to your original entry to make a profit. If you have gaps, then it's very difficult for the bears to make money selling at prior highs and scaling in. Here's another gap here. If a bear sold at this high and scaled in higher, he could not make a profit. The reversal down did not go down to his original entry price. Difficult for the bears to make money, and therefore you should not be selling. If you're selling, you're planning on making money, and if you look to the left, you're saying, oh, the bears are not making money, you don't want to join them. You should only be looking to buy. Whenever it's difficult for the bears to make money, the market's telling you you should only be looking to buy. Again, the pullbacks are just too small for the bears to make money, and the bears will lose money, and therefore you should never sell. Unlike a broad bull channel, when the bears can make money fairly easily, in a tight bull channel, it's very difficult to make money. They might make money occasionally, but they'll lose more on the bad trades, and they'll end up losing money on the day. When a trend looks like this, despite all of these reversals, the pullbacks are too small to make money. You should only be looking to buy. All bull trends are constantly forming wedge tops. 1, 2, 3, 1, 2, 3, 1, 2, 3. It doesn't matter. All bull trends are always going to be forming wedge tops. But when the channel is tight, do not sell. The bull trend ignores the wedge tops, the reversals end up as bull flags, and the market keeps on going higher. Only look to buy. Expect all reversals to fail and for the bull trend to resume. Different ways to draw wedge tops. We have a small wedge here, we have a bigger wedge here. The weak bears take the reversal, betting that the wedge top is going to be profitable. They lose money. And the weak bulls who bought for any reason, let's say above this small bull flag, they'll exit and miss the remainder of the bull trend. More wedge tops, 1, 2, 3, 1, 2, 3. The reversals are minor. They become bull flags and the trend resumes. When a beginner is trading, all he thinks about is risk. He knows that if he buys, for any reason, his stop is too far, his risk is too big. But if he sells, his stop is close, just above the high of the sell signal bar, and therefore his risk is small, and his reward is potentially huge. He sees a great risk reward, but he ignores the third variable of the trader's equation, probability. Whenever you have a very small risk, you're probably going to lose money because you cannot have a great risk-reward ratio and a very high probability. But beginners, all they see is risk, and they see the risk of buying is big, the risk of selling is small, and therefore they sell, ignoring the reality that the probability is very tiny that they'll make money selling, and the probability is very high that they'll make money buying. The probability more than offsets the risk for the bulls, and the probability is so big against the bears that the small risk gets overwhelmed by the low probability of making money, the high probability of losing money. Beginners, because they want small risk, they're looking to sell every reversal. And what they usually see are two things, wedge tops and strong sell signal bars. They're attracted to them like a fly to a light. and they just get burned repeatedly. Each loss is small, but if you have a bunch of small losses at the end of the day, you have a shockingly huge loss on the day. The trader's equation, 3 variables, and risk is not any more important than probability. The 3 variables, risk, reward, and probability, are all important, and you cannot focus only on risk. You have to always think about probability, and whenever the risk is really small, you're probably going to lose money. The probability of making money is small. Do not sell. When the channel is tight, the pullbacks are small. It's a small pullback bull trend. The market's going higher. It's a breakout on the next higher time frame, a 15-minute chart. Only buy. And if the stop is too far, then don't trade. Not losing money is certainly better than losing money. If you choose to sell, in other words, take the low risk trade, you're going to lose money. And if the risk is too big for you to use the appropriate stop, don't trade. Just watch the day unfold and learn from it. Learn that all the reversal attempts will fail and the day will keep going higher. Again, I made the point that when a channel is tight, it's a breakout on the next higher time frame. And if the market's in a strong breakout, you only want to be trading in the direction of the trend. Here's a 5-minute chart and here's a 30-minute chart. Lots of reversals, lots of bear bars, but the pullbacks are very small. And if you look at the next higher time frame chart, here I have a 30-minute chart instead of a 15-minute chart. Look at the chart. Every bar is a bull bar all the way up until we get here. And if you look at this, are you saying, wow, what a great sell setup? Or are you saying, oh, every bar is a bull bar, every close is above the prior bar's close, this is a strong bull trend, I only want to buy. And that's the conclusion you should draw when you look at a very tight bull channel. You know if the pullbacks are small, a higher time frame chart looks like this, and if you see that, you cannot be thinking about selling. This series of bars within the green channel is this series of bars. You have to train yourself to imagine what this looks like on the next higher time frame chart. Or you just simply convert it into a 15-minute chart or a 30-minute chart or a 60-minute chart, and you'll see a very strong bull trend despite the bear bars and the frequent reversals. The pullbacks are small, again, only lasting a bar or two, and then the bull trend resumes. When that's the case, only buy. If you're not sure whether you should be only buying and you see a chart like this, simple. Look at the next higher time frame, 15-minute, 30-minute, 60-minute chart. And if it's a micro channel or a very tight channel on the next higher time frame, on your time frame, the 5-minute chart, only buy. It doesn't matter that we have a lot of bear bars and reversals. The pullbacks are really small, and that makes it very difficult to make money selling. This can be confusing. We have a breakout here, and then once you start getting pullbacks, you're in a channel. And when you have a lot of pullbacks like this, frequent pullbacks and lots of bear bars, it can be confusing. You see the market going up, you see all these bear bars and all these reversals, and you think, oh, it's a bull leg in a trading range, and maybe I should start selling. But when you look at the size of the pullbacks, especially starting in here, they're too small to make money. The pullbacks mean that the trend is not as strong as during the breakout phase. However, that does not mean that you can necessarily make money trading against the trend. It's still a strong trend, but it's subtle. All the reversals and all the bear bars make it look weak, but the pullbacks are small and they're only lasting a bar or two or three, and the market keeps working higher. And as I said, you can always look at the next higher time frame or a 30-minute or 60-minute chart to get reassurance that the trend actually is much stronger than what it appears to be on this time frame. And if you're taking trades, you always have to use the correct stop, and it's often much further below than what you want it to be. If you cannot use the appropriate stop, then it's okay not to trade. Wait for the market to allow you to use the kind of stop that you're comfortable using. I mentioned that you can have a bull trend that has a tight bear channel lasting a few bars. If it lasts 10 or 20 bars, the probability of a bear breakout below the bear channel increases. If there is a strong breakout and strong follow through, it can lead to a trend reversal. Here we have a fairly tight bull channel lasting about 40 or 50 bars. The market's going sideways here in a tight trading range. Remember, a tight trading range is a tight channel that's horizontal. Here's a tight channel lasting about 6 bars and going down. So it's a small bear channel, a small bear trend that became a bull flag and the market resumed up. Because whenever the market's in a bull trend, the odds are reversals will fail and the bull trend will resume, traders will look to buy a reversal up. You can call this a tight trading range or a triangle. Traders will buy a reversal up above a bull bar. And here we have a bear trend only lasting 6 bars. I would not call it a bear trend. I would call it a small, tight bear channel. And it was a bull flag. It evolved into a triangle or a trading range. And traders will look to buy a reversal up, especially above a bull bar. They'll buy on a stop above this bull bar and get filled here. We have a couple bull bars here, a second entry, first entry, second entry, bull bar. They'll buy here or they'll buy above this bar as well. What's different about this bear channel? It's a tight bear channel like this one, but there are a couple differences. First of all, it lasted 10 or 15 bars. And then next, it has 7 bars here without a bull body, and it has 4 bars with bear bodies. When traders start to see signs of selling pressure, especially if there is also a buy climax, they begin to wonder if the bull trend has ended and the market is transitioning into a trading range or possibly even into a bear trend. Again, traders are much more willing to believe the bears are taking control if there's some kind of a buy climax. And there are different ways to draw a parabolic wedge top here. You can say 1, pullback 2, pullback 3, or 1, 2, 3, or 1, 2, 3. We have a series of buy climaxes here, pause, here, pause, here. Remember, every bull trend bar is a breakout and a buy climax. Because it's a parabolic wedge, this is a triangle late in a bull trend, possibly a final bull flag, traders will be looking for a possible reversal. Once they start to see 3 or 4 bear bars and no bull bars, they start to wonder if this is the beginning of a bigger pullback or possibly even a bear trend. Here we have 3 consecutive bear bars closing on their lows, and the bear bodies are getting bigger. This is a bear breakout, and the bulls are giving up. The bulls tried to resume the trend. They have a breakout above the bull flag, the bear channel, and it's reversing down. You can call it a double top here or a double top here. In any case, it's a failure and the market's reversing down. At this point, the market's always in short. 3 consecutive bear bars, each getting bigger, a big bear bar closing below the low of the past 20 bars or so, and we had a failed bull breakout above a protracted bear channel. Traders will sell the close, they'll sell reversals up, they'll sell reversals down, betting that this is a bear flag. If this had gone on 20 or 30 bars, the probability of a bear breakout becomes close to 50-50. When it only goes on 10 or 15 bars like this, there's maybe a 40% chance of a bear breakout, which we did get here. I talk more about these concepts in the videos on tight channels and micro channels, pullbacks and bar counting, and major trend reversals. Sometimes when you have either a bear channel, a tight bear channel, or a tight trading range, which is a horizontal tight bear channel, you can get a major trend reversal. You can get a double top within it, and it can lead to a major trend reversal. Sometimes you'll get a tight bull channel and a bear trend, and it's a bear flag. Here, we have a very strong bear trend, and now we're starting to reverse up, and we have maybe, whatever that is, a 9-bar bull microchannel, a tight bull channel. And that's a sign of strong bulls. However, it's still the first reversal up in a strong bear trend, and therefore it's a minor reversal. It's enough strength so that the bulls will probably get a second leg up after a resumption of the bear trend, but it's not enough to be thinking about the start of a bull trend. It's strong enough buying so that if the bear trend resumes, the bulls might be able to get a major trend reversal. Here they got a double bottom, higher low, major trend reversal. Usually, even with this strong reversal up, it's a minor reversal. The best the bulls will get is a trading range. However, once it forms a trading range, the bulls will have some kind of a major trend reversal setup, in this case, a double bottom, higher low. This is not a very good higher low major trend reversal because this bear channel is tight the bulls usually need a double bottom, which they got here. This is a higher probability major trend reversal. It's a higher low, and the higher low forms a double bottom. So a double bottom, higher low, major trend reversal after a decent minor reversal up here. A double bottom, and the double bottom is a higher low, so it's a double bottom, higher low, major trend reversal. Is the market still always in short here? Yeah, even with this, the bulls have not done enough to make it always in long. And even with this, still always in short. And even with this, always in short. We're still in a trading range and a bear trend. You have about a 50% chance that the double top, lower high will result in a break below the neckline and a measured move down. Here, it's closer to 50-50, but it's still always in short until the market starts to reverse up. It probably went always in long here or here. At this point, this breakout above the top of the trading range, the odds shifted in favor of the bulls. Chances are the market will go higher. Strong bull breakout and follow through, the market's always in long. However, it's also the end of the day and there's not much time left for a swing up. It's strong enough so that the odds favor at least a small second leg up. Reversal up, lower low, major trend reversal. We have a double bottom, a failed breakout below, another reversal up, another bull bar, and then a strong breakout here to a higher low, major trend reversal, probably going higher. Strong bull breakout, always in long. You can buy for any reason. You can buy the close of that bar below this bear bar, or on the reversal up from the break below the buy climax. A decent looking buy signal bar, a test of this buy signal bar high, and a good looking bull bar. And now we have another breakout and then a pullback, and now we're starting to channel up, little pullbacks along the way. But the channel is tight, the pullbacks are small. One bar pullback. This pullback didn't even go below the low of the prior bar. One bar pullback again. It's starting to become a very tight bull channel. Sometimes you look at a channel and you're not sure, is this broad or is this tight? We have a bull channel here. If you cannot decide, then assume it's tight and only trade in the direction of the trend. Remember, if it's a broad bull channel, you can buy and sell, but you certainly can buy because it's a bull trend. And if it's a tight bull channel, you can only buy. And therefore, whether it's a tight channel or a broad channel, you cannot go wrong only buying. Here we got a strong bear reversal, but look at the follow through. Strong bear reversal, look at the follow through. It's a higher low and a bull bar, higher low and a bull bar, around a 50% pullback. It's probably not worth shorting because the pullbacks are really not quite deep enough for a scalp. Certainly with a stop entry, it's difficult. Do you really want to be selling with a stop here? You can argue second failed breakout above this high, expanding triangle, 1, 2, 3, but very strong rally, probably a 50% pullback and resumption of the bull trend. It's better to be looking to buy the failed bear breakout, buy on a stop above here, or buy with a limit order around a 50% pullback from this rally. And the same is true here. You stand to make more money buying above this bull bar than you do selling that bear close. In fact, when you see a bear close like this, you know the bears need follow through. A lot of bulls will buy that close and put a stop down here. And then if the bears get a second consecutive bar, they'll exit and take a loss. But they know the probability is the market is still always in long and going higher. Easiest thing, buy a reversal up. You see a bull bar after the bear breakout, buy a reversal up and bet that the market will continue to form higher lows. Every time the market reverses, expect the reversal to fail, look for a bull bar and buy above the high of the bull bar. Remember, if you're an always in bull and you get out for any reason, let's say you get out on the close of this bear bar, if you're going to be trading always in, if you're going to stay in the market for most of the bars of the day and you just get out and the market's still always in long, even with that bear bar, you got to buy again above a bull bar. And that's why buying above a bull bar, whether or not you're trading always in long, is a good idea in a bull trend. Every reversal, when you see a bull bar, buy above it and use the appropriate stop. Anytime a market starts having very small pullbacks, you know the channel is tight. So 1 bar pullback, 2 bar pullback, and the pullbacks are small. They're not falling a lot of points. Therefore, the channel is tight and you should only be trading in the direction of the trend. Some pullbacks like this are fairly deep Because they're deep, by definition, they're not small, and therefore the market's not a small pullback bull trend here. It's still a fairly tight bull channel and very difficult to make money selling. Here, it's becoming a small pullback bull trend. Traders should not be selling. Some traders, when they see this trading range, they might sell at this high, sell more higher, look for a scalp. But if you're not sure if the channel is broad enough to take the shorts, the limit order shorts, selling at prior highs, scaling in higher, only look to buy. In general, whenever you see a bull channel, if it's not clearly very broad, only look to buy. Buy the pullbacks as they reverse up. Another thing is you can use your feelings as kind of a radar. Whenever you look at a chart and you're feeling agitated and you're desperate, hoping for a deeper pullback that will allow you to buy, then you know the market's going higher and you should buy at the market. Just buy at the market, trade small, and use the appropriate stop. The correct stops are usually fairly obvious. If you bought anywhere in here, where's your stop? Clearly below the bottom of this strong bull reversal. So stop is here. Doesn't matter if you bought here, doesn't matter if you bought here. That is your stop. And if you look at this, and then you look at this saying, oh, the bears are not doing much to reverse this. I think it's going higher, but gosh, that doesn't look strong enough to buy, right? You think it's going higher. That means you're at least 60% certain. That means you have to buy. You buy above a bull bar, buy above a bull bar, use the appropriate stop, and go for a walk and come back in an hour. A lot of times there are other alternatives for stops. For example, if you buy above this bull bar, do you put a stop here? I would not. You can argue it's a high 2 bull flag after a bull breakout, but I would use the deeper stop because we might be in a tight trading range. We're having small sideways bars. We could get a second leg down, 1 pullback 2. Suppose you buy above this bull bar. Can you put your stop below here? Well, after 3 bear bars, we still might get a second leg down, so it's still too tight. Buying above this bull bar, can you put your stop below its low or here? I would not, but after these 2 bull bars, that might be enough so that the market should not get below this low. If you had a stop here, you could tighten it up to here after you see this bull breakout or after you see this bull breakout. Reasonable stops, once the market starts to go up, if you buy above here and you get to this point, you could raise your stop. And then once you get a breakout here or here, you can raise your stop to below the most recent major high or low. Once you break out here or here, you can raise your stop. If the market is in a small pullback bull trend, it will not have a big enough pullback to hit your stop. If it does hit your stop, then it's no longer in a small pullback bull trend, and you don't want to be holding long, trading it like a small pullback bull trend. Again, your feelings can help you trade. If you're feeling like the market is just forcing you to buy too high in a bull trend or too low or sell too low in a bear trend, the market's telling you the trend is strong. If you look at it and you feel like, oh my gosh, it's climactic, we could get a big reversal at any time, what you're doing is you're just talking yourself out of an obvious trade. You have to get long. You know where the stop is. If you buy here, the stop is at least here, maybe down here. You have to buy. You just buy small, use the stop, then if you have to, just go take a walk for a half hour and come back. Clearly strongly bullish. It's climactic. We have a series of buy climaxes here, 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 and we could get a big reversal at any time. However, when a channel is tight like this, it's a breakout on a higher time frame chart. Is a breakout going to go from a strong bull trend into a bear trend? Rarely. And therefore, the best the bears will get is a minor reversal. In other words, a bull flag or maybe a trading range. And even if you get a deep pullback in a trading range, the market will probably come back here. And therefore, you can buy at any time, use the appropriate stop, knowing that if you manage your trade well, you should be able to avoid a loss, like 80% chance you can avoid a loss, and probably 70% chance if you can scale in, you'll make money. When you have a bunch of alternatives for your stops and you don't know which one to use, and you don't want to use the furthest one, just pick any one in the middle. So if you buy this close and you're trying to decide, do I use this stop or do I use this stop or this stop, just use any of them, maybe one in the middle. You want to make sure that it's far enough away so that you do not get stopped out of a good trade. For example, if you buy this close and you're not sure if you should put your stop here, the bottom of the buy climax, maybe it'll dip below that and resume up, then just use the next wider stop here or down here. Even if you get a bear reversal, again, when a channel is tight, the market usually has to transition into a trading range before it'll become a strong bear trend. And a trading range means if it goes down, the odds are high, it'll go back up again. And you can buy more lower and avoid a loss. A tight channel is a strong trend, and therefore the best the bears probably can get over the next 10 or 20 bars is a trading range. They might get a deep pullback, but the pullback will probably be a bear leg in a trading range, and the market will probably trade back up to the top of the range, which will allow traders to get out without a loss. Skilled traders will add on lower, and they're usually able to make a profit even if you do get a deep pullback or strong reversal attempt. 70% chance the first reversal down will test back up here and allow you to get out break even. 80 or 90% chance the first reversal down will bounce at least high enough up so that if you scale in lower, you'll be able to exit at the midpoint between your two entries and avoid a loss on the trade, get out break even on the entire position. Market's going sideways here. It's still always in long. Probably the best the bears will get is a minor reversal, like this one, a bull flag, minor reversal, bull flag, minor reversal, bull flag. Tight trading range, 10 bars or so. Now the market's more balanced, but it's still reasonable to rely on your stop, working a little bit higher. Is that a high major trend reversal? Probably not. Not much selling pressure. We only fell a couple points, even though two legs, and it's still probably a minor reversal. Probably the best the bears will get is a trading range. We're getting late in the day, and therefore there's always a risk of profit taking. And when you have a small pullback bull trend and you're at the end of the day, a lot of the bulls will take profits, and sometimes you get a surprisingly sharp sell-off at the end of the day. We're sideways for about 10 bars, and now pretty much still sideways to up. It's okay to change your style of trading from bull breakout trading to channel trading and now to trading range trading. In trading range trading, it's okay, especially late in the day like this, to get out below a strong bear bar reversing down from the top of the range. Failed breakout above a double top, and that means it's a type of wedge. 3 pushes up, 1, 2, and 3, even though the first two simply form a double top. Anytime you have a double top and a breakout that reverses, you have 3 pushes up. You have the 2 pushes of the double top and then the breakout for the third push. And if you get a decent sell signal bar like that, it's reasonable to get out below the low of that strong bear bar. It's also okay to hold long and rely on your stop. Maybe this point below here, late in the day, you don't want to use as wide a stop as you would if it were earlier in the day. The market tested down, formed a slightly higher low, and then resumed up again into the close. Let's say you bought at the top of this breakout. It's a buy the close reversal. You were confident that the market would probably go up for at least some kind of a measured move, maybe based upon the height of the breakout, the open of this bar to the close of that bar. 60% chance of going up here, a measured move up, and therefore you can buy that close and put a stop down here. That's your initial risk. Let's say you bought at the top of the channel. Is the probability as high that you're going to make money? No, this is a strong breakout. It's the strongest type of bull trend. This is still a pretty good bull trend, and it's a breakout on a higher time frame chart, but it's not as strong as this, and the probability of making money buying that close is not as high as the probability of making money buying this close, but it's still very good. Here's the height of the breakout. Is it still a 60% chance that we're going to go up for a measured move based upon the height of the breakout? It might be. We're probably going higher. I don't know how much higher. We have a lot of small bars here. Your risk is less. The height of this breakout, if you buy that close, your stop is down here. Here, if you buy this close, your stop is below the most recent major higher low, just below this bear bar. So your risk is less. Whenever the risk is less, usually you get better risk reward, and better risk reward usually means lower probability of making money. I began by talking about my definition of a tight bull channel. And when the market's in a tight bull channel, you should only look to buy. It's very difficult to make money selling. And anytime you look at a chart where it's difficult to make money selling, you should only look to buy. A tight bull channel is a breakout on the next higher time frame chart. For example, if you see a tight bull channel on the 5-minute chart, either the 15-minute or 60-minute charts will be in a breakout, a series of consecutive bull bars. And that tells you that you should only be looking to buy. Sometimes when you have a tight bull channel, there'll be a bull flag that is a tight bear channel. Usually it's only a few bars, maybe 5 bars long, but sometimes it can grow to 10 or 20 or more bars. That becomes an endless pullback. If you have that and then have a strong bear breakout and strong follow through, the market can be reversing into a bear trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading tight bull channels. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading tight bull channels. As long as the channel is tight, the reversal that you see will probably be minor. And if the bull trend resumes again in a tight channel, the next reversal will usually be minor as well. We have a bull channel, pullback only 1 bar. We have an II, not even pulling back, a brief pullback, not very deep. It's a pretty tight bull channel. We went sideways, and now we're resuming up, but bad follow through here and weak follow through here. The channel is resuming. Therefore, chances are the first reversal down will be minor, and that means that you'll either get a bull flag like we had here, or a trading range. And if it's a trading range, the market should test back up to the high. Therefore, if a trader buys even the worst price, the high close up here, his risk is small if he manages his trade well, which means rely on the stop, and it's better if he's able to buy more lower and then get out, break even at his first entry and with a profit on his lower entry. A tight bull channel rarely will reverse into a bear trend without first entering a trading range. And at this point, you don't know if this is an exhaustive buy climax and the end of the bull trend. It's the biggest bull bar in more than 20 bars. Possible final flag, wedge, 1, 2, and then 3. So it could be the end of the trend. But even if you do get an exhaustive buy climax, the market usually tests the low of the buy climax and then enters a trading range before the bears are able to get a major reversal of the trend, reversal from a bull trend into a bear trend. We have a tight bull channel here and a bigger tight bull channel here. The market broke below this bull trend line and it broke below that bull trend line. This is not enough bars for a major trend reversal. Not enough selling pressure, about 7 or 8 bars, but none very big. And the resumption of the bull trend was only 3 bars. That's usually not enough for a reversal from a bull trend into a bear trend, and therefore it's probably a minor reversal leading to more of a trading range. Also, not a clear broad wedge, which is another type of top that can lead to a major reversal. Therefore, the odds that this is a major reversal are maybe 30%, that this is going to be the start of a bear trend without first going into a trading range. 70% chance that it's either going to be a bull flag and the trend will resume up, or it'll be a trading range and you'll be able to get out break even at your first entry. Many bulls who buy this close expect either a trading range or a bull flag. And a trading range often tests the bottom of the final buy climax and usually has about 10 bars and 2 legs down. Leg 1, pullback, leg 2, testing the low of the final buy climax. And now we have a decent looking buy signal bar. A lot of bulls will add to their position here, relying on a stop down here, below the bottom of the most recent strong leg up. They'll add if their second entry is at least as big as a scalp below the first entry. Their goal is to get out around the first entry, break even at their first entry, and then with a scalp on their second. And therefore they want the second entry at least the size of a scalp below the first. For example, they will not add here because getting along here is not 1 point below the first entry. In the E-mini, the minimum scalp size is 1 point. And if you're looking to add on in a pullback like this, you want your second entry to be at least 1 point below the first. If the bars are big and the range is big, you might want it 2 or 3 or 4 points below the first. Get out, break even when the market gets up here. You're expecting either a bull flag or a trading range. You have a bull flag through here, and at this point it's a trading range. And if it's a trading range, there will be a bear leg and a bull leg. And that means the market should test up near your original entry price and allow you to get out, break even on your original entry price. And if you add it on, you would have a profit on your second entry. At this point, it's a reasonable lower high major trend reversal. We have a slightly lower high. We have the market selling off for about 10 bars. We have it resuming up for about 7 or 8 bars. We have another buy climax with bad follow through. And you can see when the market got back near the high close, traders took profits. And now we have a bear bar. Therefore, this might be a small double top, lower high major trend reversal, leading to a bigger second leg down. So leg 1, pullback, leg 2, or leg 1, leg 2, leg 3, leg 4. It's reasonable to get out of longs on the reversal down because it's a reasonable sell setup, and bears will take that sell as well, looking for a couple legs down after a lower high major trend reversal. You can also call it a double top lower high. This high is slightly above that, but both are below this. Remember, every major trend reversal top is a type of double top, and sometimes it's a perfect double top. Here, it looks like it's a little bit lower. Sometimes it's a little bit higher. They're all variations of a double top. Once you get a strong bear breakout, we have 3 consecutive bear bars. The bar is getting bigger, closes on or near the lows, breakout below the low of the past 20 bars or so. This is a strong enough sell-off so that the market will probably have a second leg down, and therefore a reversal up will probably fail. Traders will sell the close. They'll sell above this bear bar. It's a bad buy signal. And then we have 2 or 3 legs up, 1 pullback, 2 pullback, 3. It's a wedge lower high. Traders will sell below the low of that bull bar or on the close of this bear bar or below its low. It's the end of the day, so probably not going to fall all that far, but it's a reasonable sell. We have a tight trading range early in the day, and now we're getting a bull breakout. A decent bull bar closing above the high of the first 10 bars or so. And then we have a follow-through bar. Yes, it has a big tail, and that means the breakout is weaker than it could be, but it also confirms the breakout. Now we have 2 closes above the opening range. The market's always in long, probably going up for at least a measured move, and probably going up for a swing. Let's say you buy the close of that bar, or simply buy at the market. Whenever you have a potential buy the close market like this, a breakout and follow through, a lot of traders will just hit buy the market right before the bar closes or right after it closes. Because the market's likely to have at least a second leg up, some traders will buy at the low of this bar, betting the reversal down will fail, and others will buy the close of this bar, betting that the reversal down will fail. This is about a 50% pullback. It's testing the breakout point, these highs. It's a reasonable buy, and other traders alternatively will buy on the reversal up, especially above a bull bar. We have a bear breakout, terrible follow through. The bear breakout or the bear reversal is probably going to fail, and this is probably just a breakout test of the top of the trading range, and the market will probably go up for at least a small second leg, possibly a swing up. Stop below the bottom of the bull breakout, because if this is the start of a swing up on the open, the bulls should not allow the market to fall below the bottom of the start of the bull trend right here. If it falls below that low, then their premise that this is the start of a swing up lasting 2 or 3 hours is wrong, and they should get out and just take the loss. Once you look at a chart and you think the market is always in long, it's good to buy at least a small position. You know where the stop has to be, here or here. You just buy at the market, or for any reason, like I said, below the bar, above this bar, and just use the appropriate stop. And trade small if you have to, but you have to get long. Once you have a breakout and then a pullback, the breakout phase has ended and the market's now in the channel phase. You're expecting at least one small leg up, and you have that here. But it's a good enough breakout and follow through 3 consecutive bull bars. We're probably going to go higher. Maybe a wedge, 1, 2, 3. Maybe a swing up lasting 2 to 3 hours. Once you get a breakout on the open and the market's clearly always in long, usually the swing up is going to last at least a couple of hours. So you don't want to be too quick to take profits. Another buy the close market. If you did not buy here, or if you get out and you did not get long again here, you could simply buy the close. Now we have another strong breakout to a new high. You could put your stop below this low. If you get stopped out and the market reverses up from around this low, you could buy again. I always pay attention to whether or not a pullback from a breakout falls below the breakout point. We have a breakout and we have a pullback from the breakout. Did this low fall below this high? We have a breakout above this high right here, and the pullback fell below this high. We have another breakout and the pullback fell below this high. That's a stairs pattern, and that means if the pullbacks are deep enough, bears selling at the prior high using wide stops and scaling in higher can make money. It often is a sign that the bull channel is weak and that it might soon transition into a trading range, which it did here. However, if the pullbacks are small, like this and like that, very little overlap, very difficult for the bears to make money. A bear selling this high probably did not make money. I can't tell if this fell low enough for them to make a 1-point scalp. If a bear sold this high and sold more at 1 point higher, maybe he made money. But it clearly is very difficult for the bears to make money, and that means the market's probably going higher. The bears are not aggressive, and the bulls are buying even small pullbacks. The result is that the market probably will have to go higher. The market broke above this high, so this is the breakout point. When it broke here above these highs, that was the breakout point for this breakout. This is the breakout point for that breakout. And you can see the low of the pullback fell below the high of the breakout point, and therefore this channel is a stairs pattern. We're getting overlap instead of gaps. Here we have a gap. This pullback did not fall below that breakout. There's a gap between this low and that high, and that's a sign of a strong trend. You assume the odds are you'll get at least a small second leg up. First leg up, pullback, testing the breakout, not falling below the breakout point. Odds are we'll get at least a small second leg up. When you're looking at the market anywhere through here, you know it's a trend. When you look at a chart and you know it's a trend, that means you believe that there's a 60% chance the market is going higher. It never feels like it's that certain, but the reality is, if you look at the chart and you say, yeah, that's a bull trend, what you're saying is you believe there's at least a 60% chance of it going higher. And as a trader, 60% is as good as it gets. Therefore, you have to trade. The easiest way to trade is just buy at the market and use the appropriate stop. So if you buy anywhere through here, the appropriate stop is down here below the most recent major high or low. We're getting pullbacks, but the pullbacks are small and they're brief, only one bar. It didn't even fall below the low of the prior bar. A few bars, but did not fall very many points. If you look at a higher time frame chart, maybe a 30 or a 60-minute chart, instead of getting pullbacks, you'll have a series of strong bull bars closing at or near their highs. That means this is a breakout on a higher time frame chart. And the higher time frame chart is only a time frame or two higher than the current chart. And if you have a breakout on the next higher time frame or the two higher time frames up, 15-minute, 30-minute, 60-minute, then you should not be thinking about selling. Whenever the market is in a small pullback bull trend like this, you know it's a breakout on the next higher time frame, 15, 30, 60 minutes. And if it's a breakout on a time frame not much different from this, you can only look to buy. When you're in a channel, there are usually gaps and trading ranges that allow you to project measured move targets above. It's not as strong a trend as the breakout phase, but it's still a high probability bet that the market is going higher. The probability of a lot higher prices is less, but there's also less time pressure because you're getting pullbacks. It gives you time to think. In a strong breakout where you get bull bar, bull bar, bull bar, bull bar, bull bar, you don't have time to think. The market just keeps going up and you have to buy. Here, when you get pullbacks, it gives you a little bit more time to enter on a pullback. You see where the stop has to be. The market's moving up less quickly and you have more time to analyze what to do. Whether you're entering a breakout or a pullback, the risk is going to be the same, or the stop is generally just about as far. We're in a channel, so it doesn't matter where you enter. The stop is going to be about as far as it would be in a breakout trade. For example, if you buy up here, the stop down here, you're risking about as much as a trader who bought the breakout, buying up here, stop down here. The reward is usually a little bit less in a channel than in a breakout, because a channel is a weaker trend and there's less profit remaining. You've already left the breakout phase and now you're on the channel phase, and the next phase is a trading range. Once it's in the channel phase, it's less likely to extend as far up as it would when you're looking at the breakout phase. So there's a little bit less reward remaining in the trade as well. The problem that everyone faces when they're trading in a channel is that from the market cycle, you know a trend begins with a breakout, you get a pullback, and then it enters a channel phase, and then eventually it evolves into a trading range. The bears tried to bend it over into a trading range here. They failed. We got trend resumption up. They tried again here, and they succeeded, and then eventually we got a trend down. To evolve from a trend into a trading range, you need a break below the trend line. So we have a bull trend line here. It broke below the bull trend line. It's a bull flag here. Once it gets 10 or 20 bars sideways, then you start to call it a trading range. We resumed up, and then here we broke below the trend line. Not a very strong breakout, but sideways for about 10 bars, probably starting a trading range. Once you have a bull channel, you have a 75% chance of a bear break below the channel. That means a break below the trend line, the bull trend line, and it can come by either a reversal or simply by the market going sideways. Here we have a bull channel, a wedge bull channel. We broke below the bottom of the channel by going sideways. The bull trend resumed, and now we have a broader bull channel. And again, we broke below the bottom of the channel, the bull trend line, by simply going sideways. Only a 25% chance you'll have a bull channel and then a strong breakout above the top of the channel, leading to an even stronger bull trend. Breakout to new high, but it pulled back within a bar. Breakout to new high, pull back within a few bars. Breakout to a new high, a pullback again within a few bars. Breakout to new high, and then a pullback within a couple bars. We're getting frequent pullbacks, and that is a sign that the trend is weaker than when it was in the breakout phase. Traders are disappointed by how the market's behaving once it gets to the new high. We're breaking out. The breakout bar is not very big, has a tail on top, and then disappointing follow through, a bear bar. We're breaking out again, not a very big breakout bar, followed by 3 dojis and then a couple bear bars. We're breaking out again with okay follow through, but overall the bars are fairly small. Channels usually evolve into trading ranges. You have a bull breakout, pullback. This whole thing is a channel. You expect a bear breakout either by going sideways or down, and then eventually a trading range. A trading range means it tends to test major higher lows like here and possibly all the way down to the bottom of the channel, which it did near the end of the day. The bulls are disappointed by the small breakout bars, the tails on tops of the bars, the bear bars after every breakout. The lack of very big bull bars, the breakout bars not being all that big, all of that increases the chances that this bull channel will end up being a bull leg in a trading range, which means the market will have some kind of reversal, a bear leg in the developing trading range. At this point, we're in a trading range. We went up, we went down. This is a bear leg in the range, and this is a bull leg in the range, even though it's also a bull leg and a bull trend. Eventually, when you look back, the trading range began somewhere down here. We have consecutive bull bars, but they're not particularly big. Again, the sign of a channel and not a strong bull breakout. It disappoints the bulls, and it makes them quicker to take profits, and it makes them prefer to buy pullbacks instead of buying at prior highs. So instead of buying at this high, creating a strong breakout, they're taking profits, and we're getting pullbacks at every new high. We have a bigger breakout here, and it took 20 or 30 bars to get down below the breakout point, but eventually it did. And the bears who sold this high and scaled in higher eventually made money. They get out break even on their first sell right here at this high, and if they held and used a wide stop, they made money on their higher sell. It's a fairly tight channel, and therefore it's a reasonably strong trend. Traders will take the same buy setups as they do during the breakout phase. There's a big difference though. In the breakout phase, they're willing to buy at or above the high of the prior bar, betting that the breakout will succeed, and they're also willing to buy bull closes. This is a buy the close bull trend. When the market's in a channel and they see these disappointing deep pullbacks, the bulls are buying the pullbacks, and when it gets to a new high, they're selling to take profits, or at least partial profits. They are concerned that the rally is probably not all that strong, and it can turn into a trading range at any point, and therefore they're taking at least partial profits at prior highs. And then they buy again on a pullback. Instead of buying the breakout here the way they bought the breakout here or bought that close here, they're concerned that this deep pullback means maybe the next breakout will have a deep pullback as well, and therefore they'll take partial profits at a prior high and above. Whenever the market's in a tight bull channel and it tries to reverse, the reversal is usually minor. If the bull trend resumes, again staying in a tight bull channel, the next reversal will probably be minor as well. A minor reversal means either a bull flag, which leads to a resumption of the bull trend, or a trading range, and the reversal down probably will go back up and test the bull trend high. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading in tight bull channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading tight bull channels. I'll begin by talking about scaling into trades. I also want to make the very important point that if the bears cannot make money selling, then the bull trend is strong and bears should not start to sell. They should wait to sell until they see other bears making money. The bulls have a breakout and then a 1-bar pullback, and then about a 10-bar bull microchannel, and then a couple bars down, 1 bar down, 3-bar pullback, a pretty tight bull channel. Even if a bear sells at the prior high and scales in, the pullbacks for the most part are not deep enough to make even a scalp, and most bears will not short until they start to believe that the channel is ending and transitioning into a trading range, or at least a broad channel. Selling above this high, not making money. Selling at this high, scaling in higher, very difficult to make money. Stop entry bears, it's even more difficult to make money. Selling below that low, selling below this low, or that low, or that low, or this low for that matter. In general, when a channel is tight and you look at it and you see that it's difficult for the bears to make money, you should only be looking to buy. And every time you see a stop entry sell, a reversal attempt, you should assume it will fail, the bears will not make money, and they'll have to buy back their shorts. And therefore, bulls will be buying every reversal attempt, betting that the bears will lose. When the market's in a bull trend, the bulls are always looking for reasons to take at least partial profits, and they'll take partial profits above prior highs or at prior highs. For example, they might take some partial profits here, and that creates a small pullback. We get a new high here, some of the bulls will take partial profits again, a pullback. So the pullbacks are common, and that's what creates a channel. We have a breakout, a spike, and then we start getting little pullbacks as bulls take partial profits. Once they see the bears are unable to reverse the market, the bulls buy again, betting that the reversal attempt will be a bull flag and that the bull trend will continue higher. When the pullbacks are small like this, most bears will not short. The bear is certainly not going to be holding for a swing trade, looking to sell more as the market's going down. In general, bears will not sell until they see evidence that bears can make money selling. On the other hand, the bulls are eager to buy the reversal attempts because they believe each one will become a bull flag and that the bull trend will resume. Until the bears are consistently making money, bulls are going to buy aggressively. The bears, they see a spike, pullback, second push, pullback, third push. So a wedge bull channel, and they get a reversal down. Initial target, the beginning of the channel, the bottom of the channel down here. However, when a channel is tight like this, for example, there's not a pullback in 10 bars. Bulls are going to be eager to buy at or below the low of the prior bar. They've been buying above the low of the prior bar for 10 bars. Therefore, when you get a very tight bull channel, it does not matter that there is a wedge. If the channel is a wedge but the pullbacks are very small, it's not going to lead to much of a reversal, and it's better to be looking to buy below the low of the prior bar than to sell. Therefore, even though someone might look at this and say, oh, it's a spike pullback channel, it should test down to the beginning of the channel. No, when the channel is this tight, the reversal is going to be minor and become a bull flag, and more likely you'll get a measured move up based upon the height of the wedge. Breakout, measured move up. I want to be clear about this. Whenever you have a channel and you have a bull breakout above the channel, the initial target is the bottom of the channel, the bull trend line here. But when the channel is tight, that target is not far enough for a scalp, and therefore traders cannot sell. If this was going to be a successful reversal, the target for the bears would be the beginning of the channel. Sometimes I call that the bottom of the channel, but it's really the beginning of the channel. The bottom of the channel is the bull trend line here. The initial target for bears looking to sell a wedge top is the bottom of the channel, which is the bull trend line. Their next target is the beginning of the wedge. Whenever a bear is looking to sell a reversal down from a failed breakout above a bull channel, he's going to be selling with a stop below the reversal bar, and his first target is the bull trend line, the bottom of the channel. However, when the channel is tight, you're selling at the first downside target, and therefore there's not much profit to be made. If the channel were broader, you might be hoping to get it moved down to the beginning of the channel, but that's not likely when the channel is this tight. The lesson is, whenever you have a tight bull channel, never sell with a stop. Bulls will buy where you're going short, and they will win and you will lose. When the market is channeling up like this, some bears will sell every new high and scale in sometimes 1 or 2 or even 3 times as the market's going up. Once there's a reasonably strong breakout like this and a follow-through bar, the bears will stop selling. So a bear who sold here would probably get out and take the loss, and some traders would reverse the long, expecting that the market would recover their loss. So if they sell at this high, they buy on the close of the follow-through bar and then exit to recover the size of the loss that they made on their original sell. Let's say, for example, bear looked at this as a trading range and he sold with a limit order at this high. He'd get filled right here. Maybe he would risk about 5 points, maybe a measured move up based upon the height of that range. If he risked about 5 points or so, his stop might be up here. Why would he want to risk about 5 points? Let's say he's looking to scale in at 1 point intervals. He might scale in once or twice, sometimes even 3 times. He knows that if he has to scale in 5 times, 4 or 5 times, he's in a losing trade. He's going to lose money. And therefore, if he puts a stop 4 or 5 points above the first entry, and his premise is valid, he should be okay. If his stop gets hit, the market's telling him that his premise is wrong. It's a catastrophic stop. You put the stop far away, you're never planning on letting the stop get hit. Usually, there'll be evidence that you're wrong before the stop gets hit, and once you see that evidence, you get out. For example, if you had a limit order to sell at this high, and then you saw a bull bar closing on its high, you might want to get out if the next bar is a bull bar. So you exit on the close here or on the close here, and do not wait for that stop to be hit. A trader, a bear, might sell at this high, and you might have limit orders in the market to sell more 1 point higher, 2 points higher, 3 points higher. After a strong bull bar like this closing above the high of the past 10 bars, most traders would cancel their orders to scale in 1 or 2 or 3 points higher. They would wait to see what the market does before they'd scale in. If a trader did scale in 1, 2, or 3 points higher, he would probably look to get out, break even on his first entry. In other words, on a pullback to below this breakout point. And you can see the market went 1 tick below. Even with that strong bear reversal, it still resumed back up. And this was a pullback from this breakout and not a reversal. The bears were lucky here. If a bear took this short and sold more 1, 2, 3 points higher, he made profit on his 3 scale-in entries and he could out break even on his first entry. As I said, most traders, if they see a strong bull breakout bar like this and they had a limit order to sell at this high, they'd get filled, but they would not sell 1 point higher. They might place a limit order to sell 2 or 3 points higher and then try to avoid a loss and get out at the midpoint between their second entry. Let's say they sold 3 points higher and their first entry. They would be so disappointed by the breakout and follow through that they think the market's going higher. They simply want to get out to avoid a loss and not worry about a profit. In this particular case, if a trader did sell here and more here and more here and more here, he was lucky. He got out break even. The market fell 1 tick below his original entry at that high. He made 1 point on his first scale-in trade, 2 points on his second, and 3 points on his third. He made a total of 6 points. However, what was his risk? If he had a 5-point stop, his risk was 5 points on the first entry, 4 points on the second, 3 points on the third, and if he got filled on a fourth, he would have had 2 points risk on that, and his total risk was 14 points, yet he only made 6 points. That means you need an extremely high winning percentage to make this profitable, and that's beyond what most traders can do. The scale-in bear, in this particular case, ended up risking 14 points to make 6 points. Can that result in a positive trader's equation? Well, it can. Scaling into any trade increases the probability of success, the probability of making money, the probability of avoiding loss. However, it comes at the price of increased risk. In a situation like this, you have to be probably 90% certain of making money doing this scale-in trade to take the trade, because if you're risking more than 2 times your reward, it's not worth taking the trade unless you're 90% confident that you're going to succeed. 90% certainty is very rare. Even expert traders rarely will look at a trade and say, oh yeah, there's a 90% chance I'm going to make money. Again, you pay for high probability with bad risk reward. If you're scaling into a trade, you're increasing the probability of making money, but you're paying for it with increased risk and usually diminished reward. Most experts would not scale in like this. As I said, if they took this short, they might scale in once they see the big tail on this breakout bar, but most would simply get out and take a loss. An expert will only scale into a trade if he can look at the trade and structure it in a way so that he feels like he has a reasonably good trader's equation. And when I say structure a trade, I mean you have to have a plan with several alternatives, and you have to be willing to make very quick changes, and that's something that beginners cannot do. So beginners should not be scaling into trades, especially scaling into trades against a trend. It's a different thing to be scaling into trades with the trend. For example, buying this bar and then buying more above here, a high 2 bull flag, or here, a triangle. That is something beginners can do if their account is big enough and if they're trading small enough. I talked about how if this stop got hit, the bears who took all of these trades, scaling into their trade, would lose 14 points. However, as I said, it's really important to know that experienced traders are not going to let that happen. They'll rarely ever let their wide stop get hit. They'll decide that their trade is bad long before their stop gets hit, and they'll get out with a much smaller loss. You're not going to keep adding to a trade once you decide the trade is bad. So for example, let's say you took the first entry selling here and you placed a limit order to sell more here and you get filled at the high of that bar. Most traders will just get out at the market, or they'll get out on that close. You're going to decide that the premise is bad and that we're going higher. And if you're fast enough, not only will you get out, you'll buy looking for at least a small second leg up. For scale-in traders, most of the losers and winners are only 1 to 3 points. But if you're winning more than 60% of the time, that is a very profitable strategy. High probability can offset bad risk reward. Bad risk reward means big risk and small profits. And that's usually what you're doing if you're scaling into shorts in a bull trend. If the channel is broad, a skilled trader can scale in to shorts above prior highs and win 90% of the times. His average win might be 3 points, might be more. So if he takes 10 trades and has 9 wins each for 3 points, he wins a total of 27 points. And if he loses one time times 14 points, he would have a 14-point loss compared to his 27 points win. Again, that is not this trade. That is if the channel is broad, which this is not. In a very tight channel here, we have at this point a 6 or 7 bar bull micro channel. That's a tight channel. All the way up here, no pullback for 10 bars, very tight channel. Anyone scaling in is going to be disappointed and he's going to exit pretty quickly. So for example, if a trader did take this short and he sold any of these additional shorts, he'll probably try to avoid a loss rather than make a profit. That means that instead of hoping to get out break even on his first entry, he'll look at his average price and simply hope that the market comes down far enough so that it reaches his average entry price, allowing him to get out break even on his entire trade. This means that the trader taking the short, if he looks at the rally, he's saying, oh, this is too strong. I'm going to give up my idea of making a profit. I'm simply going to scale in to avoid a loss, thinking that there'll be a pullback that drops far enough so that I can get out without a loss. It'll fall below my average entry price, my first entry and whatever my second entry is. When the channel is tight, if you are scalping shorts, your average win is probably only going to be 1 point, maybe 2 points. A very difficult way to make a living. I personally do not sell above bars when the channel is tight. I'm only looking to buy. However, once the market becomes two-sided, or if the channel becomes broad, then I would consider selling at prior highs and scaling in higher. Again, if you're scalping for 1 point in a tight bull channel selling at prior highs, you have to win 90% of the time. Even then, you're barely going to make any money. Most great traders are rarely going to short on a tight bull channel because they know the math is bad. It makes much more sense to do the opposite. Buy breakouts, buy closes, buy bear closes, buy below bars betting reversals will fail. And because of that, an experienced trader is not going to be selling in a very tight bull channel. I always pay attention to whether or not bears can make money, and that's really, really important. If the market's in a bull trend and the bears are having a very difficult time making money, that tells me two things. One, I don't want to be shorting, and two, I can buy for any reason at any time and I'll have a very good chance of making money. I'm always looking at every breakout. Will the market reverse down enough to make money? If a bear sells that high and he scales in higher, can he make money? Is it easy to make money as a bear? And if it's not, then I'm going to be buying every reversal down, betting that the reversals will fail and that the trend will continue up. Here, you can argue we have a breakout and more breakout here, but a big tail, so maybe the market's not all that strongly bullish. Also, the follow-through bar is small, so it's not a particularly strong follow-through bar, so you can argue that we're getting disappointing follow-through from the breakout. The bears believe the market is always in long. We have a breakout, we have more breakout, we have follow-through. However, they also look at it and say, well, that big tail, that small follow-through bar, maybe we'll get a pullback that drops far enough down for a scalp. If a bear did short and scale in higher, or if he did not take that short and simply sold at the close of this bar or at the close of that bar, he's going to be looking for a scalp, a 1-point scalp. Since the bears made money selling this high and scaling in higher, this low fell below the breakout point, some bears will continue to do that. We have a new high here, we have a breakout, some bears will sell that high. But did they make money? Probably not. And then we have a new high here and a bull breakout. Did the bears make money selling this high, scaling in higher? Maybe, but they clearly did not make much, and it was not all that easy to do. It's difficult for the bears to make money selling prior highs. Here, they sold at that high, and the market pulled back just enough for them to exit with a 1-point profit. Bears sell this high, sell more 1 point higher. It dropped back below this high, and they were able to make 1 point on that scalp as well, break even on their first entry at that high, and then a 1-point profit on their second entry. Bears see that they're barely making money on their shorts, and as soon as it hits their limit order to buy back their shorts with a profit, it continues up. To me, this is not easy for the bears to make money. When I see a situation like this where the market barely falls far enough for them to make money and they have to scale in to make a 1-point scalp, I think it's not worth shorting. The bear reversal attempts will fail and become bull flags. The bears will decide that the bulls are very strong, and therefore the bears will become less willing to sell at prior highs and scale in. They'll wait until they see the market become more two-sided, more of a trading range. When the bulls see that it's hard for the bears to make money, they're confident that the market's going higher. They expect at least a couple legs up and maybe some kind of a measured move up, and therefore they are more willing to hold on to their trade for a swing up. The market's trying to enter a trading range here. We have a bull breakout with bad follow-through. Some bears would sell this high, betting that the breakout will fail before it goes too far up, that this might be the final bull flag. And they might put a stop about 5 points up, arguing that if they scale in 1, 2, or 3 times, that's okay. The market still might be good enough for them to make a profit selling. But if they have to scale in 5 times at 1 point, 2 points, 3 points, 4 points, 5 points, then their premise is probably wrong. Therefore, they don't want to continue to hold short. Some bears would sell at this high, sell more 1 point higher, sell more 2 points higher. Other bears will take that short and not scale in 1 or 2 points higher. They'll sell, and then they'll look for a bear bar, like here, and sell more below a bear bar. We have a bear bar here, but the market did not go below its low. Also, had they sold below this low, it would be less than a scalp above their first entry, so most traders would not scale in there. What they're looking for is a bear bar. They sell below its low, and they expect the market to come back down to their original entry. They want this entry to be at least 2 to 3 times the size of a scalp to make it worthwhile. So if an average scalp in the E-mini is 1 point, they want this entry, if they're going to take it, to be at least 2 or 3 points above their first entry. And then they hold, hoping for the market to come back down to their original entry, where they can get out break even on their first entry, and then with 3 or 4 points profit on their third entry, depending on how much above the first entry their second entry is. In general, this is a better approach. Instead of selling the high, selling more higher, selling more higher, wait instead to sell below a bear bar when the channel is tight. When the channel is broad and you can see that every breakout does not go very far before it reverses, then you might be more willing to scale in 1 point up, 2 points up. The market came down exactly to their first entry, exactly to this high, and they were not able to get out. What would I do in that situation? Well, I'd look at the entire structure. We have a high 1, a high 2, it failed. We have 2 more legs down, 1 and 2. You can call it a high 4 type of pattern, a complex bottom type of pattern. We have a high 1, high 2, tried to bottom, it failed. And then 2 more legs down, 1, 2, tried to reverse up again. So a complex bottom, or you can simply call it a big high 2, leg 1, pull back, leg 2. And we have a micro double bottom here at the target price for the bears. They want to get out break even on their first entry, which is at that high. And now we're getting a second reversal up, first reversal, second reversal up, with a micro double bottom and a bull body. That's a reasonable buy. If you're a bull, you're going to take that buy. And if you're a bear, had you taken this short and sold more below this bear bar, you'd get out here. You'd have a small profit on your second entry, a small loss on your first entry. Some bears would continue to hold short, arguing that the market is transitioning into a trading range. And if it's a trading range, it probably will fall below support, which would be this low and this breakout point. You can look at it as possibly a trending trading range. We have a trading range, a brief breakout, not all that strong, and then another trading range. When you have that, there's a 60% chance the market will fall at least one tick below the top of the lower range. And the bears know that, and some bears, or at least experienced bears, might be willing to hold, expecting 60% chance will drop below that high, which it did here. However, I would not. To me, this is a reasonable buy, and if I'm selling in a bear trend and I see a reasonable buy, I'm going to get out. A lot of bears, if they sell that high and they sell more higher, and then they see the close of this bar, and then they see a follow-through bar also closing on its high, they're going to assume the breakout is strong enough to have at least a second leg up, and they'll just get out with a loss. They sold here, they sold more 1 point higher, and they'll get out on the close of this bar. And that's another reason why when you get a breakout with a follow-through bar and a bull trend, bulls will buy. They'll buy that close, they'll buy the reversal down, they'll buy above the high of this bar, betting that there'll be at least a second leg up, far enough up for them to make at least a scalp. What about reversing? So let's say you sold here, you sold more here, you decide on the close of this bar that it's going higher. Most experts do not like to reverse because they feel they're not objective. They've been looking at the market as a reasonable sell, and now they're looking at it as a reasonable buy, and usually it's just tough emotionally to make the switch. However, the math is pretty good. If you did take that sell and sold more here, and then you reversed along here, you're probably going to get a rally big enough to reverse the losses that you had over here. And that's a common situation. Whenever you think the market is going to do something and it does the opposite, usually if you take a reversal trade, you'll be able to recover your original loss. So if you sold here and let's say you bought on that close, usually the market will go up at least that far so that you'll be able to make enough on your long to offset what you lost on your short. Some traders will reverse the long, most will not. They'll exit, and then they'll look to buy, maybe at the low of this bar, looking for at least a scalp up, a scalp equal to the size of their loss. We have a very tight bull channel, and we're getting a pullback, so it's a high 1 bull flag, a high 2 bull flag, a high 3, so a wedge. And now it's about 10 bars into the bull flag, and at some point you have to decide, maybe it's an endless pullback, and it's going to lead to a reversal instead of a resumption of the bull trend. Every bear channel is a bull flag, 75% chance you get a bull breakout. But in a situation like this, where the rally is fairly climactic, here, 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 and then you get an extensive pullback like this, the probability starts to go up that you'll get a bear breakout and a measured move down. Whenever you have a bull flag and it lasts 20 or more bars, here it's not 20 bars, but it might be 10 or 15 bars, you got to be thinking that it might be the final bull flag and that the breakout, when it comes, will probably not get very far before you get a reversal down. Here we have a breakout. Does not look like we went to a new high. Sometimes you'll get a final flag reversal and the breakout did not even lead to a new high. The breakout failed at a lower high, which is the case here. Failed breakout above the bull flag, bull breakout, reversal down, 3 consecutive bear bars closing on or near their lows. The odds are we're going to get at least a small second leg down, which we did over here at the end of the day. It's fairly common for a bear trend to begin as a bear breakout below a bull flag. We have a bull flag, we tried to get a bull breakout, did not get very far, and then we reversed down, bear breakout below the bull flag. And you'd expect a second leg down because the breakout is reasonably strong. Therefore, bears will sell this close, and we get 2 or 3 legs up. We went up here, little bull bar, and then a bear bar. Up again, 2 more bull bars, and then a bear bar. And then up a third time. This is a wedge lower high, a double top with this sell climax high, and about a 50% pullback. Even though it has a bull body, it's a reasonable short, expecting a second leg down into the end of the day. Bears, they're selling, they'll sell this high, 1 point higher, 2 points higher, 3 points higher, sell that high, sell this high, sell this bad close, sell that high, sell more higher. We have a pullback here, but look at how small the other pullbacks were. They're non-existent here. That means it's really difficult for the bears to make money. And eventually they stop trying. At some point, after trying here, maybe here, the bears stop selling. And if you have a relative absence of bears selling, the odds are the market's going to go higher. The bears want to sell higher. They want to sell after the market begins to enter a trading range. They'll stop selling in a tight bull channel. Here, the bears sell more 1 point higher, 2 points higher, 3 points higher, and they were lucky to get out break even. That means it's really difficult and very stressful, and the risk reward is terrible. You had a large risk, very little reward, and not great probability. That means it's hard for the bears to make money. The same with all of these other sells as well. And when that's the case, eventually the bears stop selling. Very common for the bulls to get a breakout with a follow-through bar. So we have a decent bull bar, and then the next bar has a bull body. That increases the chances that the bulls will get at least a second leg up. And as I said, if you're taking these shorts here and more higher, it's hard to reverse. Most traders don't do it, and therefore it's hard to make up the loss that you got from taking the scale in short, selling at this high and selling more higher. Therefore, don't do it. Also, if you do it, just get out and take the loss and don't worry about reversing too long. Because it's so difficult to make money, and because the risk quickly gets bigger than the reward, and you need a very high probability of success, it's very, very difficult to make money. There's no room for mistakes. You have to trade perfectly or you're going to lose. And it's not easy to do, even for an experienced trader. Therefore, most experienced traders are not shorting when you have a very tight bull channel like this or like this. Tight channel, better only if you look to buy. And it's clearly a good trade to buy because the reversals last 1 bar or are very small, and the odds are we're going to go higher. Also, if you're thinking about shorting, you probably will not take any of the buys. You'll just keep looking for shorts, looking for shorts, looking for shorts, and you'll end up missing a bull trend that rallied 8 points above the breakout. Whenever you're looking at a market from one perspective, long or short, in this case, if you're looking at it to sell, and it's really hard to do, that's telling you that it's usually better to do the opposite. So if you look at it and say, wow, it's pretty difficult to make money selling, well, don't sell, only buy. In fact, every time you see something that you think is a sell, do the opposite, buy exactly where you're selling. I talked a little bit about scaling in to shorts in a very tight bull channel, and I made the very important point that I'm always paying attention to whether or not the bears can make money. If the market's in a bull channel and it's very difficult for the bears to make money and they can only make very little money and they have to scale in and their reward is much less than their risk, then it tells me that I should only be doing the opposite. Instead of selling, I should only be looking to buy. The channel is too tight to make money as a bear, easy to make money as a bull. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading in tight bull channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on trading in tight bull channels. The first thing I want to talk about is how to buy when you have a tight bull channel. Next, I want to talk about management. Where do you put your stops and when do you take profits? And finally, it's important to realize that all tight channels eventually evolve into trading ranges. The channel here is fairly tight. The pullbacks are only a bar. Here we didn't even pull back below the low of the prior bar. And here we got a brief pullback, not very deep. The channel is tight. On a higher time frame chart, it's a breakout, and you trade it like a breakout, which means you should focus on buying instead of looking to trade in both directions. At this point, we have a breakout and a follow-through, and then another follow-through bar, and we try to reverse back down, but we found support at the top of the trading range. We do not yet know if it's going to be a tight bull channel, but the breakout's strong enough so that the odds are traders will get at least a second leg up. Here, here, here. At this point, we have 7 bars with higher lows, 6 or 7 bars with higher lows, and it is an early tight bull channel. If you buy for any reason after this initial rally, your initial stop is going to be below the most recent strong breakout. Once you get another breakout, you can use a tighter stop below the most recent major higher low. A major higher low is a higher low where you have a strong breakout, usually to a new high. Let's say you're planning on buying this close. The first thing you have to look at is where a logical stop would be, and it would be below the bottom of the breakout, maybe below the bottom of the bull trend. Once you're confident that the market is going to have at least a second leg higher, it's reasonable to go ahead and just buy at the market. As soon as you see this bar close, you hit buy the market, and you'll get filled on the open of the next bar, or you can place a buy the market order a second or two before the bar closes, and simply rely on your stop. At this point, there's a high probability that you'll get some kind of a measured move up based upon the height of this breakout, maybe from the open of the first bar to the close of the second bar, which would be somewhere up here. Once the market starts channeling up, here we have a microchannel. Microchannel means the low of a bar is above or at the low of the prior bar. And at this point, we have 4, 5, 6, 7 bars where every low is either at or above the low of the prior bar. That's a sign of a strong bull. It's a tight channel, and on a higher time frame chart, it is a breakout. And therefore, you can trade it exactly like you would a breakout. Buy for any reason. There's one thing that's different between a tight channel and a breakout. Even though it's a breakout on a higher time frame chart, in general, it's better to buy reversal attempts. You buy when the market is trying to go down. So you buy with limit orders below this bar, or now we have a pullback, and you can buy a reversal up, rather than buying above this high. At this point, you know there's going to be a second leg up, and then at this point, and then through here, you know you have a tight bull channel, and you're probably going quite a bit higher. You know it's going higher, therefore that means you have at least a 60% confidence that it's going higher, yet it never really feels like 60%. But as a trader, 60% certainty is as good as it gets, and therefore you have to figure out how to buy. An obvious choice is just buy at the market, or buy the close, or right around the close, right before, right after the bar closes. You can buy the breakout close, better yet, higher probability to buy the close of a follow-through bull bar or the bar after that. The bears are trying to reverse the trade, but the odds, even after this big bear bar, are that we'll get at least a small second leg up, and therefore you can buy the bear close, betting that it will not totally reverse the breakout. We have 3 consecutive bull bars here, a bad sell signal bar. This is a bull inside bar. That lowers the probability that this will be a successful failed breakout and the start of a bear trend. It's more likely a 50% pullback of this rally and a test of the breakout point, these highs, and the high of this doji bar. If you cannot decide what to do and you see it starting to reverse up, you simply buy the market. And that is a very easy way to trade. You know where the stop is, you just buy the market. You don't know that it's going all the way up here, but you know that there's a high probability, better than 60%, it's going up. Beginners naturally are afraid to buy when the market is falling in a bull trend. And that's reasonable. But the math is still good to take the buy if you rely on your stop. Buying pullbacks is always a good strategy whenever you're in a bull trend. Also, betting that bear reversals will fail and become bull flags is also a good strategy. Here, for the bears, they're hoping that the breakout will fail. However, the odds of it failing after 3 consecutive bull bars, and with this being a bull bar for the sell signal bar, are small, and therefore probably buyers below the low of this bar, and you can place a limit order to buy at the low of that bar. You get filled here and stop down here. You could also buy a 1 or 2 point pullback below a strong close. Strong close here, strong close there. Just place a limit order to buy 1 or 2 points down. Then you have a strong bear bar, but the bears need more than 1 bar to create a reversal. This is more likely a test of the breakout point than it is the start of a bear trend, and therefore, again, you could simply buy the close. As soon as you see the bar close, you just hit buy the market. Again, stop down here. Because it's a channel, it's not likely to have 5 or 10 consecutive bull bars without any bear bars. You're going to get pullbacks. And that means there'll be many opportunities to buy below the high. For example, buy below a bull bar, betting that it's a terrible sell signal bar and that the market's going higher. Again, as I said, you could buy lower. In fact, you could scale in lower. Wherever your first entry is, you could buy more 1 or 2 points down, assuming you're trading a small enough position size so that you can scale in. Pullback testing support, the top of the trading range. It's also about a 50% pullback. You could buy with a limit order at that high or just above this high, or a limit order at a 50% pullback, which is also around the same price. Here's the start of the breakout. Here's the top of the breakout. This is around a 50% pullback. We have a bull bar after the bear bar, so that is a bad bear reversal attempt, and it's also a bull flag. We pulled back for 3 bars. We have a bull bar, a buy signal bar, reversing up from a test of support. You can buy with a stop just above the high of this bull bar, and you get filled right here. The market has been above the moving average all day to this point. That is maybe 50 or 60 bars above the moving average. Traders have been willing to buy above the average price. So what's going to happen when it finally gets down to the average price? They're going to buy. And therefore, traders will place a limit order to buy either at the moving average or 1 tick above the moving average. And they could get filled right around here. You can buy a breakout at the prior high. So for example, you can place a stop order to buy at this high. You get filled just above that high. However, bulls, when there are channels, tend to take profits when the market gets to a prior high. Therefore, the bulls who bought for any reason down here would take partial or full profits here. Since this is always in long and early in a trend, I think bulls will take at most only partial profits. You can see the tail on the top of this bar and the bear bar that followed, and that is a sign that bulls took profits. You also have limit order bears selling at this high, hoping that this is going to become a trading range and not a bull trend. However, when the market did not continue down, the bears had to buy back the shorts. We have a bull II, we have a bull inside bar, and this bar is an inside bar, so it's an II. Second bar has a bull body, it's a bull II. The bears who did sell at that high will buy back their shorts above this bull II, and the bulls who took partial profits, a lot of them will buy more above this bar, betting that we're starting a second leg up. It's a channel, getting reversal attempts repeatedly, but it's also a bull trend, and therefore you can buy at any time, including on a stop and a breakout above a prior high. However, as I said, when the market is channeling, it's usually better to buy pullbacks. And if you prefer stop entries, you could look for any kind of a pullback and place a stop to buy above the high of a bull bar. You get filled here. A pullback, even though it's an II and it did not go below the low of the prior bar, you can buy on a stop above the high of this bull inside bar, or here, or here. You can also buy any strong bull close here, 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 here. However, buying bull closes at new highs, especially after the market has rallied for 20 or more bars, becomes risky because the chance of a deeper pullback becomes greater. Later in a bull trend, it becomes even more important to not buy the strong breakouts and instead buy pullbacks, because every bull channel eventually evolves into a trading range. Let's say you bought this high. The stop is always going to be below the most recent major high or low. This is probably a minor high or low. We went to a new high, but it was only a 1-bar breakout and the bar's not all that big. I think this is a more major high or low. So if you bought for any reason through here, by the time the market gets up here, this is where the stop goes, below this low. If you did buy this close, the high close of the entire bull trend, and you relied on your stop, and you saw the market sell off for the next 10 bars or so, you can place an order to buy more above a bull bar. Like, for example, here. Can you buy above this bar? When I'm scaling in a situation like this, where I bought a high close and I'm looking to buy more above a bull bar, I prefer the second order to be at least 2 or 3 points below the first, 2 to 3 times the size of a minimum scalp. In the E-mini, a minimum scalp is 1 point, and therefore, if I'm going to add on, I prefer to add on 2 or 3 points below. So I would not buy above this bull bar. However, buying above this bull bar makes sense, again, relying on that stop. And again, you only do it if you're trading small enough so that your risk is no bigger than on any other trade. Let's say you're a bull who bought here, then you bought more here. Are you happy with what you see here? Of course not. You're disappointed. We have over here 6 or 7 bars without a bull bar, and the bars are starting to get small. We're starting to go sideways. So you're going to conclude that it's no longer a strong bull trend. It might simply be a trading range. You bought here on the assumption that it was going to be a continuation of the bull channel, and it's not. We're starting to go sideways. And because it's no longer a strong bull trend, you'll probably want to get out around your original entry. So a lot of the bulls will switch to trading range mode at this point. They'll look to get out of their trade around here. They get out break even on this buy, and then they have a profit here. Remember, you're buying here, hopefully about 2 points below there, so you get a 2-point profit here, and then you just wait to see what happens next. The bears see this, and they know the bulls are disappointed, and they know the market's transitioning into a trading range, and they know the bulls will try to get out around the high close. And because of that, bears will start selling for scalps right around where the bulls will give up, which is at that high close. In general, whenever the market is in a channel, especially when the channel is tight, anytime the market pulls back a third to a half of the prior bull leg, the bulls will start to buy. We rallied, and this is pulling back about a third of this leg up. We rallied, this is pulling back about half. When the pullbacks are small, like they are here, really difficult for the bears to make money. If they sell this high for a scalp, did they make money over here? Probably not, and the market's resuming up. Whenever you look at a chart and you think about it from the perspective of limit order bears selling with limit orders at the prior high, and you see that it's very difficult for the bears to make money, that means the market is going to go higher. Therefore, you should be looking to buy, and you should especially be looking to buy every reversal down, believing that it's likely the bears will get trapped. The reversal down will be minor, which means it'll become either a bull flag or a trading range, and the odds of it leading to a trend reversal are small. Even here, became a trading range, and the bulls were able to avoid a loss. The odds that the first reversal down is going to turn into a bear trend are small. Usually the market has to sell off for 10 or more bars and then resume up and fail around the prior high. At that point, the bears have a chance of a reasonable sell-off. But until you get this sell-off and the test of the prior high, the odds of this are small. And therefore, bulls can buy for any reason until after they see this. Again, here's a leg up. Bulls will be looking to buy any reversal down that retraces about a third of the rally. to about half of the rally. This is a third, this is a 33% pullback, and here's a 50% pullback. It did not quite get there, but that's the buy zone, between a third and a half. That's where bulls start looking to buy again. You can buy with a limit order at a 33% retracement or at a 50% retracement. Here, it never hit the 50% retracement, so if you tried to buy with the limit order, you would not be filled. Instead, you could buy a high 2 bull flag. High 1 above this bar, and now we have a high 2, and we have a bull body, so that's even higher probability. You can buy with a stop on that reversal back up above that buy signal bar. Whenever a channel is tight, usually the pullbacks only last 1, 2, or 3 bars before the bull trend resumes. We have a 1 bar pullback. We have a 1 bar pullback that does not even go below the low of the prior bar. We have a 2 bar pullback here. It extended. We have a third lower bar. This bar is below there. This bar is below here. This bar is below here. It's actually probably a 6 or 7 bar pullback, but only 3 of the bars went below prior lows. We have another pullback here for a few bars. And we have a 1 bar pullback here. That is a small pullback bull trend, and it usually means the market is going higher. And that's a sign of a very tight bull channel. If all the pullbacks are very brief like that, that means the market is probably going higher. Because the pullbacks are 1 bar, bulls will buy at the low of the prior bar, believing that the pullback will only last 1 or 2 bars, maybe 3 bars, and certainly not fall very far. You can buy with a limit order below the low of the prior bar, especially if the bar has a bull body like this, like that, like that. Those are low probability sells, and therefore you can buy at the low of those reversal attempts. Another thing you can do is, if the pullback is likely only going to be 1, 2, or 3 bars, instead of buying below the low of the first bar, you can wait for a 1 bar pullback and then buy at the low of that bar. You can also buy at the low of the second pullback bar. This bar went below the low of that bar. That's a 1 bar pullback. This bar went below the low of this bar, so it's a 2 bar pullback. You can place a limit order to buy at the low of that bar, and you get filled over here, betting that the pullback will not last more than 1, 2, or 3 bars. Again, even if you are buying in what turns out to be the start of a bear trend, the market will be forgiving, because the first attempt to get a reversal, the first significant attempt, is probably not going to succeed without the market first testing back up at the prior high. Even if you buy here and the market keeps going down, the odds are high that you'll be able to get out at least break even, that the market will come back to your entry price and you'll be able to avoid a loss. When you have several reasons to buy, if you take one of these buys and then you see another buy signal, another one, another one, another one, another one, in general, you will not take the additional buys. You'll take one. Maybe you'll take a second or third if you can get it 1 or 2 times the size of a scalp lower. So the minimum scalp in the E-mini is 1 point, and if you buy there, maybe you'll buy more 1 point lower or 2 points lower. But you're not going to be taking these entries if they're all within a point or so of one another. Also, you're not going to be taking them if it creates risk that's greater than your acceptable risk. If you're taking any of these buys, your stop is down here, and you do not want your position size to be bigger than what it should be in order to keep your risk within a reasonable level. At this point, we have an 8 bar pullback in a very tight bear channel. That's a good sign that the momentum is waning and the market's probably beginning to transition into a trading range. Therefore, if you bought, assuming that this channel was going to continue up, and now you think it's not, it's going sideways, you're disappointed. And you'll decide that the style of trading is no longer appropriate, and therefore you want to get out around break even. You're buying in a way that's appropriate for a bull channel, but if it's now a trading range, that's not how you want to be trading it. So you'll get out of your trade around break even. I'm going to talk a little bit now about stops and profit taking. Let's say you buy the close of the follow-through bar after this breakout. You have a 2-bar breakout. An initial reasonable stop is below the bottom of the breakout, although you could also put it below the bottom of the bull trend. It doesn't matter where you bought in here, anywhere in here, this is where your stop goes. And that's true of any leg. It doesn't matter where you buy in here, you're using the same stop, here, below the most recent major high or low. Your entry price has nothing to do with the stop. The location of the most recent major high or low is the only thing that matters. Anytime there's a reasonably strong breakout, especially to a new high, you move your stop up to below the bottom of that breakout. That's trailing your stop up. Breakout, new high, reasonably strong breakout. If you're betting on a channel, it should not fall below this low after breaking to a new high. Since you're buying on the premise that it's a channel, if it goes below there, then your premise is wrong and you want to get out. So it's appropriate to have your stop there. Another breakout, not all that strong, but we have a bull bar closing on its high. We have 3 consecutive bull bars. Reasonable to put your stop below the bottom of that channel, below that bull bar, maybe below that bear bar. Another breakout to a new high, decent bull bar. Reasonable to put your stop below the bottom of the leg up or below this low. Another breakout, even though it's only a 1-bar breakout, it's a breakout to a new high. It's also getting late in the trend, and you have to be thinking that the market is not going to go up forever. We have consecutive breakouts here, 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 here. Usually that transitions into a trading range. And because of that, I think you have to be thinking that you want to get out quicker. And therefore, it's reasonable to put your stop here after simply a 1-bar breakout. Also, this is the biggest bull bar in maybe 20 bars. Whenever you see the biggest bull bar after a trend that's going on 20 or more bars, it's more likely an exhaustive end of the trend than it is the start of a new leg up. And that's another reason to put your stop here. If it gets down here, you don't want to be long because your premise of a bull channel is no longer valid. It's probably now in a trading range. Let's say you're buying for a scalp here or buying for a scalp here or here for any reason. You're still going to be using the swing stop. It's usually the best choice. It gives you higher probability. And it's especially good if you're able to scale in. So if a bull scalper bought, let's say here, it's better to use this stop and not put a stop here. So they buy above this bar, get filled here. Better to put a stop down here so they can buy more if it gets lower because you don't want to be stopped out and then have it reverse up again on a high 2 bull flag, high 1, high 2. Or let's say you buy above this bar, I would put the stop down here because we might get one more little push down below that low. And again, you don't want to get stopped out at that point with a high 3, a wedge bull flag. Pretty late in the bull trend to be buying highs, but we have a trading range and now we're breaking out and we have follow through. It's okay to buy that close if you use the appropriate stop. Can you put the stop below the low of this one breakout bar? You probably can, because if your premise is right, that this is the start of a new leg up, it should not drop below the low of this bar. Also, we're getting pretty late in the trend, and whenever you see a big bull bar late in a trend, especially if it's bigger than the prior 20 bars, there's an increased risk that the trend will end soon. This is a strong enough breakout so that we'll probably get a second leg up. This is a strong enough breakout for maybe more up, but you were expecting a second leg. And this is the second leg. You can buy this close. I personally would not buy that close. I would wait to see what we get. In any case, let's say you buy this close. Either stop is reasonable. A tighter stop, you'll get stopped out more often, but you'll lose less when you do get stopped out. A wider stop, when you do lose, you lose more than with this stop, but you'll get stopped out less often. A wider stop has higher probability of making money, but the risk is greater. Both stops are reasonable, and therefore you can use either one. And if you take this trade 100 times using this stop, and 100 times again using this stop, your profit will be about the same. Because it's a bull trend, at least you believe it's going to be a bull trend, it's always reasonable to swing at least part of your trade. Most traders should be swinging all. So if they buy this close, for example, it's better to be swinging most or all of your trade. Again, because it's an early trend, the probability of making a reward at least equal to your actual risk is at least 60% when you use the appropriate stop. If you buy this close, your initial risk is one tick below the low of this bar. And once the market resumes up to this point, you now know that your actual risk was to one tick below the low of this bar. You buy here, your actual risk was here. 60% chance you're going to have at least a profit of 1 times your actual risk. That is an acceptable trader's equation. When you have a reasonably strong breakout, 60% chance the market's going to go up for some kind of a measured move. And therefore, the minimum you need for a positive trader's equation is a profit that is only 1 times actual risk. This is 1 times actual risk, and you can see what happened when the market got there. Some traders took profits, and that's what caused that. It's a reasonable swing trade, and it's therefore reasonable to swing all of your position. You should certainly be swinging at least part of your position. And look what happened when the market went to 1 times initial risk. You buy here, initially your stop is below the low of this bar, and this is 1 times initial risk. And you can see what happened, more profit taking. So some computers are taking partial profits at 1 times actual risk. If the actual risk is fairly small, instead they'll use 1 times initial risk. So other computers took profits up there. The probability is high, and therefore taking profits at 1 times actual risk or initial risk is reasonable. Certainly taking profits at 2 times actual or initial risk is reasonable. And swing trading the rest of your position makes sense. Most traders should be swing trading at least half of their position. When do you exit? Well, you exit when there are a couple decent reasons for traders to assume the trend is ending, and it might be transitioning into a trading range. And then you can exit your position on a stop order on a reversal down from the resistance, or with a limit order right around the resistance. Resistance, 1 times actual risk, is always resistance. Reasonable to take partial profits there. 1 times initial risk is also resistance. It's resistance because some computers will be taking profits there, which means the market will probably stall there. Reasonable to take partial profits there. Every channel eventually ends. 25% of channels break out and become an even stronger trend, maybe less than that. 75% break to the downside, and the bull channel becomes a trading range. Traders can trade it like a channel until it's no longer a channel. Whenever a trend goes on 20 or more bars, traders should begin to look for signs that the channel might be evolving into a trading range. You can see there was an attempt to do that here. We have a wedge, 1, 2, 3. Then we have a couple legs sideways, 1 pullback 2. This subdivided into 1 pullback 2. However, the bull trend resumed. We have a rally here, and then an attempt to reverse, but whenever you have a tight bull channel like this, the first reversal attempt probably is going to result in a trading range or a bull flag. However, you got to be thinking about measured moves. If this is the first leg up and we have a pullback, and now the bull trend is resuming, there will always be some profit taking at around leg 1, leg 2 measured move up. First leg, and then the second leg started here, and that is a measured move up. We have consecutive tops. We have a wedge top here, not likely to fall very far because the channel is tight. The bull trend resumed, but now we have a second wedge top. Whenever there are consecutive tops, there's a higher chance that the trend will end and either become a trading range or reverse into an opposite trend. Whenever you have a high 2 buy setup, here's a high 1, high 2, and then here's a bigger high 2. This is a high 1, high 2, but it's also a bigger high 1. So this is a high 1, this is a high 2. Whenever you have a high 2 that occurs 20 or more bars into a bull trend, there's at least a 50% chance it'll be the final bull flag. and that means that you'll get a leg up and then a pullback into a trading range or a deep pullback into a very big trading range. I mentioned this earlier. Whenever you have a relatively big bar, big compared to the past 20 bars, occurring 20 or more bars into a bull trend, it's more likely to be an exhaustion move than a breakout into an even stronger bull trend. At the close of this bar, there's a gap between its close and the high of the prior bar. Chances are that gap is going to close, so that means chances are you'll get a pullback that falls below the high of this bar. It's especially likely if the bar following the breakout is a bad follow-through bar for the bulls, and here we have a reversal bar with a bear body. We have a breakout, probably going to get a second leg up, and we have a second leg up. We're not necessarily going to get a third or fourth leg up, and therefore the minimum goal after this breakout has been achieved. Another reason for traders to take profits. We have a breakout bar and bad follow-through. Buy the close bulls are disappointed. You're starting to get a series of dojis. That usually leads to some kind of a trading range. I think it's reasonable to take final profits below this bear bar because of all that I said. Leg 1, leg 2, consecutive tops, wedge, wedge, possible final flag. Expect a second leg up after this, first leg, second leg, and the biggest bull bar late in a bull trend, probably an exhaustion bar. Reasonable to take profits there. We have a series of buy climaxes. Every trend bar, every series of trend bars is a climax. This, a little bit here, here, usually evolves into a trading range. Usually you'll get 10 bars, 2 legs sideways to down. Maybe leg 1, pullback leg 2. Tight channel, so maybe leg 1, pullback leg 2. Big bear bar, increasing bear bars. We have a doji, and now we have a bear body, a bigger bear body, and a bigger bear body. This is a sign that the remaining bulls are giving up. Some bulls, after this breakout, put their stop below here, arguing it's another major higher low. However, I would not do that because at this point it's a trading range, and I'm going to be selling out of longs on a reversal down after any rally. I'm not going to rely on a stop. This is a trend stop, and at this point the market's probably in a trading range and no longer in a trend. And you can see a lot of traders gave up. And a lot of traders did, in fact, sell below this low. For me, I would sell below this bear bar. This is caused by the remaining bulls taking profits and the bears seeing the market turning down. And they know the bulls will give up, so the bears are selling as well. Big bear bar, a surprise bar, surprisingly big bar, the biggest bear bar of the entire day. We know the bulls are giving up. Probably will get at least a second leg down, and therefore it's reasonable to sell that close, expecting that any reversal up will form a lower high and we'll get a second leg down. We have 3 consecutive bear bars, each one getting stronger, all 3 closing at or near their lows. Strong bear reversal. The bulls are hoping this is a big high 2 buy. Leg 1, pullback leg 2. They have a bull body here, but this is so strong the odds are the reversal up will fail and we'll get a second leg down, and therefore bears will sell at the high of the prior bar, above this bar, especially since it has a bear body. Stop up here, the top of the most recent major lower high in a new bear trend. We have 3 legs up. We have a bull bar here and then a bear bar. 2 bull bars and then a bear bar and then a bull bar. So it's 3 pushes up. It's a wedge rally. It's a double top with the top of the sell climax high. It's a test of the breakout point. It's around a 50% pullback. Even though it has a bull body, I think the market's always in short. Reasonable to sell on a stop below the low of that bull bar and get filled right here. A low 2 bear flag, low 1, pullback low 2. I think of it more as a wedge. Up, down, and then up again. We have a very tight bull channel, and then we have a break below the trend line. The channel is very, very tight. The reversal is probably going to be minor, become a bull flag or a trading range. However, every time a tight bull trend has a correction that breaks below the trend line, you can draw a new line. You'll see that the lines get less steep and the channel gets broader, and eventually the market transitions into a trading range. We can draw a new line after this reversal up. We broke below it. We resumed up. You can draw a new line. You can see the lines are getting less steep. The trend is becoming flatter, and it's also becoming broader. It was very tight right here. If I draw a line across the top of the channel, you can see the trend is becoming broader. Another attempt to reverse up, you can draw another line, and you can see the trend is becoming less steep. It's becoming flatter and flatter and flatter, and eventually it evolves into a trading range. It's a trading range at this point. This is probably going to be a bear leg in a trading range, and this entire collection of bars is probably going to end up as a trading range the next day. Big up, big down, big confusion, and the market probably will go sideways for the next 20 or 30 bars. Very tight bull trend, and it evolved into a trading range. Once it's in a trading range, breakout mode, 50% chance there'll be a successful bull breakout, 50% chance there'll be a successful bear breakout, 50% chance the first breakout will fail and reverse. Anytime a trend lasts 20 or more bars, you should look for signs that it might evolve into a trading range. This channel was so tight, it was unlikely to be the end of the bull trend. But here we have a second wedge top, 1, 2, 3, after this wedge top, higher probability that we would soon evolve into a trading range. Very strong bull trend. It's a small pullback bull trend. We only have a 1-bar pullback. This bar is a bear bar. It doesn't even pull back. This is the first pullback in a very strong bull trend. The odds are it'll become a pause in the bull trend, a bull flag, and that will get trend resumption up. However, we've had the trend resumption up, and now we're starting to get a lot of very small bars, doji bars, bear bars, and this is probably the end of the bull trend. The probability that we're going higher after you see about 10 bars is no longer 60%. It becomes 50% once you start to get 10 or 20 bars in a very tight range like this. 50% chance you're going higher, 50% chance you're going lower. Again, 50% chance the bull trend will resume, 50% chance the bull trend will reverse into a bear trend. Very strong bull channel. All channels eventually end. We have a spike up here, a pullback, and now we're starting to channel up. 75% chance whenever you have any channel, you'll get a bear breakout, a break below the bottom of the channel. The breakout can be down or it can simply be sideways. 25% chance you'll get a bull breakout above a bull trend and then an even stronger bull trend. Here we had the bear breakout and the bull trend resumed and it became a broader bull channel. It was very tight here and it became broader here. I began with talking about many ways to buy in a very tight bull channel. Again, when the channel is tight, you should only be looking to buy. It's a breakout on a higher time frame chart. And next I talked about where to put stops. If you're buying in a bull trend, you should be putting your stop below the most recent major high or low. And where to take profits. Your minimum goal is always 1 times actual risk if it's a trend, because if a trend, the probability of making your profit before hitting your stop is 60% or higher. If 1 times actual risk is too small, then go for 1 times initial risk. And if the trend is strong, try to swing at least half of your trade. Do not scalp your entire position. And finally, all channels, whether or not they're tight, evolve into trading ranges. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on trading tight bull channels.